Ladies and gentlemen, good day and welcome to the Avalon Technologies Limited Q3 FY26 earnings conference call. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Thakur from JM Financial. Thank you, and over to you, sir.
Good afternoon, everyone, and a warm welcome to the Q3 FY26 earnings call of Avalon Technologies. To take us through the result today, we have with us from the manager, Mr. Kunamit Bicha, Chairman and Managing Director, Mr. Bhaskar Srinivasan, President, Mr. Suresh VR, Chief Financial Officer, Mr. Sriram Vijayaraghavan, Chief Operating Officer, and Mr. Venki Venkatesh, Chief Sales Officer. Mr. Bicha will give an overview of the business performance and will be followed up by Mr. Suresh remark on the financial performance, post which we will open the floor for the Q&A. As we move forward, it is important to bear in mind that any forward-looking statement made during this call are subject to potential risk and uncertainties, both known and unknown. Now, without any further delay, I will hand over the floor to Mr. Bicha for his initial remark, the CMD. Thank you, and over to you, sir.
Thank you, Jignesh. Good evening, ladies and gentlemen. On behalf of Avalon Technologies, we extend a very warm welcome to our Q3 FY26 earnings call. We thank our investors for your continued trust and support. Your confidence in Avalon has been an important contributor to our consistent progress in execution, financial performance, and operational discipline. Q3 FY26 marks our sixth consecutive quarter of sustained growth. We delivered improved performance across key financial and operational metrics, including revenue growth, profitability, order book growth, net working capital days, asset turns, cash flow from operations, net debt to equity, and return on capital employed. We have also made steady progress in new product introductions, including semiconductor manufacturing equipment and power systems. The external environment is also supportive of our long-term growth. U.S. tariffs have reduced from 50% to 18%, benefiting our U.S. export business. In India, the government direction towards India Semiconductor Mission 2.0, with a focus on semiconductor equipment, aligns well with our capabilities and recent business wins. Our efforts to build a meaningful sales presence in Europe over the last few quarters also coincide with the India-Europe trade deal. Overall, we believe we are well positioned from both a company and market perspective. Q3 FY26 saw our highest ever revenue and profit after tax in the history of the company. This is supported by well-diversified growth across both verticals and geographies. With improved business visibility, a better macro environment, and ongoing project ramp-ups, we are revising our FY26 revenue growth guidance upward to around 40% from the earlier guidance of 28 to 30%. Moving on to the key financial highlights for 9 months, FY26. Revenue for 9 months FY26 was at rupees 1,123 crores, representing a year-on-year growth of 48.7%. Our average revenue growth over the last 6 quarters has been 46%. Our focus on manufacturing complex box build systems continued to gain traction, with box build contribution improving from 49% in FY25 to 53% in 9 months FY26. As of December 31, 2025, our order book grew 26.5% year-on-year to 2,016 crores, with an average execution period of 14 months. In addition, long-term contracts with execution timelines ranging from 15 to 36 months is at rupees 1,100 and 83 crores. Order book growth remains well balanced and diversified across industry verticals and geographies. Gross margin for 9 months FY26 was at 34.6% at the upper end of our guided range of 33 to 35%. EBITDA for 9 months FY26 was at rupees 116 crore, reflecting a growth of 59.2%. EBITDA margin improved to 11.5% in Q3 FY26, supported by operating leverage. Profit after tax for 9 months FY26 was at 72 crores, an increase of 83.3% year over year. Profit after tax for Q3 FY26 was rupees 33 crores. India manufacturing operations, which continue to serve both domestic and global customers, accounted for 78% of our total revenue in Q3 FY26, delivering a very healthy profitability with an EBITDA margin of 16.7% and a PAT margin of 11.9%. Revenue from our US manufacturing operations contributed the remaining 22%. Net working capital continued to improve during the third quarter. On a quarter-on-quarter basis, net working capital improved by 13 days from September 2025 to December 2025. Receivables reduced by 8 days sequentially. Inventory declined by 3 days sequentially as programs moved into execution phase. Payables also improved by 2 days sequentially. Overall, the improvement in net working capital supported a positive cash flow from operation of rupees 51 crore in Q3 FY26. We continue to follow a capex-like model. Asset turns improved from 7.5 times in FY25 to 9.5 times in Q3 FY26. Net debt remained low with a net debt to equity ratio of 0.04. As a result, return on capital employed improved to 18.8% from 11.3% a year ago, reflecting continued efficiency in capital utilization. On the topic of tariffs, the long-awaited trade deal has been announced, with US tariffs on imports from India reduced from 50% to 18%. During this period, we were able to recover 99% of the applicable tariffs from our customers. Supported by a long-standing presence in the US, deep market understanding, and strong customer relationships. More importantly, this period of elevated tariffs helped us accelerate on new set of business opportunities. Alongside wins in the domestic Indian market, we accelerated new program wins in the US for US manufacturing, as customers look to diversify supply chains and reduce risk. At the same time, we have made progress in expanding exports to Southeast Asia, further broadening our geographic footprint. With the tariff reduction now in place, another growth lever comes into play. India manufacturing for US customers becomes even more attractive, strengthening one of our core competencies. As a result, domestic growth, new regions of export, and US-focused India manufacturing are coming together, giving us confidence in a strong and well-balanced growth journey ahead. Now, moving on to key growth drivers and an update on major programs, we remain encouraged by progress across our 3 growth drivers. 1, existing business. This is driven by long product life cycles, mission-critical products, and steady recurring revenues. Growth remained well diversified across rail, aerospace, industrial, clean energy, and communication. In 9 months FY26, the industrial vertical contributed 35% of our revenue and grew 67% year on year. Rail, as part of our mobility segment, contributed 16% and grew 70% year-on-year, while aerospace contributed 8% and grew 64% year-on-year. Clean energy accounted for 19% of our revenue and grew 35% year-on-year. 2. New business wins. This is built on sustained effort over the past 2 years, with these programs now translating into fresh orders and production ramps across multiple verticals. Our dual show model and the new Chennai export facility have supported the scale-up. The energy storage system program is fast-growing and ramping in line with our plan. Also, we are making steady progress in aerospace cabin sub-assemblies. We have successfully completed the first tranche of prototypes for a communication customer, where we are manufacturing control units for satellite antenna systems. We expect volume orders to commence from FY27. Our prototypes catering to industrial processing sector and power sector have commenced. In the semiconductor equipment, we have completed the project readiness phase for a key customer, marking an important milestone ahead of volume production. We expect this program to begin contributing meaningfully to revenue during FY27. The government's ISM 2.0 focus on semiconductor equipment aligns well with our capabilities and recent wins. We are progressing steadily in this space, partnering with global major to deliver Industry 4.0 compliant complex systems. 3. Opportunity pipeline. We continue to see a diverse and expanding set of opportunities progressing towards finalization, with encouraging potential in both size and scope. In recent quarters, we onboarded new customers across industrial and defense segment. Products include mission-critical power inverter platforms, critical components for an integrated battlefield command system. In what could be the first to Avalon, we are bidding on exciting opportunities in advanced metal cockpit assemblies and landing gear components in the aerospace segment. Further, we are on the cusp of foraying into cable commodity with a major customer in aerospace. Last but not the least, we are witnessing increased interest from aerospace majors in our cable and electronics commodities. These opportunities are long-term in nature, and we hope to continue our focus on developing the aerospace vertical. We will continue to provide updates as projects evolve. In summary, Q3 FY26 reflects a period of sustained execution and disciplined profitable growth for Avalon. We delivered our 6th consecutive quarter of sequential improvement, achieved the highest revenue and profit to date, strengthened margins, improved working capital, generated positive operating cash flow, and enhanced return on capital, all while maintaining a capex-light balance sheet. Our growth remains well diversified across verticals and geographies, supported by a healthy expanding order book, steady progress in new programs, and multiple growth levers coming together. Recent tariff reduction announcement of ISM 2.0, progress in semiconductor equipment, and expansion into new export markets further strengthens our long-term growth outlook. With all the 3 growth drivers gaining momentum, manpower costs stabilizing, and operating leverage beginning to play out, we are well positioned for the next phase of profitable growth. We remain focused on execution and will share our FY27 outlook once our budgeting exercise is completed next quarter. With this, I would like to hand over to our CFO, Suresh Veerappan, for a detailed overview of our financial performance. Thank you.
Thank you, KV, and good afternoon, everyone. Thank you for joining the call today. Our growth journey would not have been possible without your continued trust and support. We are delivering strong and sustainable growth supported by improving profitability, cash generation, and capital efficiency. Revenue growth was 49% year-on-year in both Q3 FY26 and 9-month FY26. This performance has been accompanied by improvement in operating cash flows, net working capital, and return on capital employed. Over the past few quarters, we have seen consistent sequential progress, with each quarter building on the previous one. This reflects the strength of our diversified business model and our disciplined approach to execution and capital management. Growing domestic demand, the government's ISM 2.0 focus on semiconductor manufacturing equipment, and recent trade developments with the US are strengthening the Indian electronics manufacturing ecosystem. Coming to our Q3 FY26 performance, revenue for Q3 FY26 was INR 418 crores, up 48.7% year-on-year from INR 281 crores in Q3 FY25 and 9.2% sequentially. For 9-month FY26, revenue from operations was 1,123 crores, delivering a year-on-year increase of 48.7%, supported by diversified growth across industries and geographies. In Q3 FY26, revenue mix was 36% from India and 64% from the US. For 9-month FY26, the revenue mix was 38% India and 62% US. India grew 35% year-on-year, while the US grew 59% year-on-year in 9-month FY26. Gross margin for Q3 FY26 was INR 143 crores with a margin of 34.2%. For 9-month FY26, gross margin was INR 389 crores with a margin of 34.6%, representing a year-on-year growth of 42.7%. Margins remain within the guided range. During the period of elevated tariffs, we were able to pass on over 99% of the tariff impact to customers. As a result, there was no material impact on absolute margins, although gross margin percentage was impacted by approximately 100 basis points during this period. EBITDA for Q3 FY26 was INR 48 crores, up 38.5% year-on-year with a margin of 11.5%. For 9-month FY26, EBITDA was INR 116 crores, up 59.2% year-on-year with a margin of 10.4%. Margin expansion during the quarter is driven by operating leverage as revenues continues to scale. PAT for Q3 FY26 was INR 33 crores, up 35.9% year-on-year with a margin of 7.7%. For 9-month FY26, PAT was INR 72 crores, up 83.3% year-on-year. Profitability continues to strengthen, delivering sustained profitable growth. On the new labor code, our existing practices are largely aligned with the requirements, and we do not anticipate at this stage a material impact on the group's financials. The estimated incremental impact of INR 33 lakhs has been recognized in the quarter. Financial implications will be further evaluated as relevant rules and clarifications are notified by the government. Moving to the balance sheet. Net working capital days improved to 118 days in December 2025 from 150 days in December 2024, a reduction of 32 days. Inventory days improved from 103 days to 97 days, while trade receivable days reduced from 94 days to 72 days over the same period. Trade payable days increased from 46 days to 52 days. On a quarter-on-quarter basis, net working capital days improved by 13 days from 131 days in September 2025 to 118 days in December 2025, supported by improvement across inventory, receivables, and payables. In the previous call, we had guided net working capital days in the range of 120 to 130 by March 2026, and we are currently below this range as of December 2025. Cash flow from operations was positive at INR 51 crores in Q3 FY26, supported by improved working capital management and profitable growth. As of December 31st, total debt was INR 143.2 crores with cash equivalents and investments of INR 113 crores, resulting in a net debt of INR 29.8 crores. Capex for Q3 FY26 and 9-month FY26 was INR 10.7 crores and INR 35.1 crore respectively. We continue to operate a capex-light model with asset turns at 9.5 times. Return on capital employed improved to 18.8% compared to 11.3% a year ago. Avalon's dual presence in India and the US provides strategic flexibility. Our India operations offer a cost-efficient and scalable manufacturing base, while our US facilities support localization and tariff management. This positions us well to support customers amid evolving trade dynamics. With improved business visibility, we have revised our FY26 revenue growth guidance upward to around 40% from the earlier guidance of 20 to 30%. To summarize, Q3 FY26 delivered strong operating and financial performance, supported by broad-based growth across segments and geographies. We continue to see growing demand from Indian customers and increasing program activity across other geographies, including the US and Southeast Asia. With our established track record, dual-shore operating model, and expanding capabilities, Avalon is well positioned to capitalize on the opportunities ahead and support customers through the next phase of growth. Thank you. We request the moderator to open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Sumit Sneha with Macquarie. Please go ahead.
Yes, thank you very much. Couple of questions. So first, congratulations on a good quarter. Secondly, talking about the guidance implication, 40%, that's obviously very strong, but that implies like fourth quarter revenue growth of about 21%. Is that your continued conservatism, or are you thinking about it from a high base perspective? Because last year, fourth quarter was also very strong. Secondly, you obviously went through a series of investments to increase your operational capacity. Are those investments done? And secondly, we're talking about your growth being much higher than probably expected, at least externally. What sort of, and these high asset turns, when do you need to probably reinvest to kind of continue to grow at a high pace in fiscal 27? Because that seems like several new customers coming on board, large customers coming on board in fiscal 27. Thank you.
Thank you, Sumit, for your kind words as well as the question. I'll try to answer all of them. If I miss something, just ask me. So we've always maintained that we'll do asset turns between 7 to 10 times, and we'll continue to do so. We still believe there's enough capacity looking for, apart from the 2 new facilities coming up for space. So we still think that our capex is around 50 crores a year, which is lower this year, but will be around 50 crores a year for the next couple of years at least. And in the next 2 or 3 years, we may look for a larger facility or duplicating what we have in Avalon, but not in the near term or mid term. And again, on the first part of your question is that, yes, we are conservative, okay, because the different programs cut in at different times for us. And this last 9 months has been tariffs, no tariffs, what tariff, what percentage. So we were really reluctant to come out with a specific number because we didn't know. We didn't know what the tariffs are going to do to our business. And I'm very happy to say the team has managed this very well, and you've seen this growth in spite of the tariffs, okay, coming in both in India as well as in our geographies. And saying that we're expanding to other geographies also, so that we'll never be in this situation again where the tariffs destine our future. So we will have it diversified, but our focus will also be on export, just not India. And India is very key to our larger growth. Did I answer everything, Sumit, or is there something else I missed?
I think there was one question about your operational investments that you started at the beginning of the year, and you had said that that'll end by the third quarter. So has that, all those investments been made? Maybe it was headcount, maybe it was systems and operations. Are those done?
So, yeah, you can see that in our numbers itself. It's been flat quarter to quarter. There'll be some swings as you grow at this pace, but by far I would say for the existing programs we are well covered. But our hope is that we get much larger programs in the future, so we'll have to focus on basically people-based investments to get the right person on board. So as of in the short term, I think it is going to be flat or plus or minus a few points. Suresh, you want to add something to that?
I think you've covered it, really.
One final. Yeah. Sorry. Go ahead, Suresh.
So there will be a combination of existing programs which continue to ramp up from pilot phase to ramp-up phase, and then there will always be new programs which will come in parallelly as well. So I think with the kind of pilot programs that are expected to ramp up in the near term, we are covered in terms of investments, but it's going to be a combination of both.
Got it. And there's one final question. In terms of this 99% recovery of tariffs, is there a rupee number that you can give us? Like, what was the leakage? I'm just trying to understand if that goes away, that doesn't become a headwind, how much your margins could expand next year.
So typically we do not share a tariff absolute number over there, but just to give you a heads up on that, let's say without tariff, our gross margin percentage would have been better by 100 bps.
That's perfect. Okay. Thank you very much. Congratulations once again.
Thank you, sir.
The next question comes from the line of Tanay Shah with DAM Capital. Please go ahead.
Hi, sir. Good afternoon, and congratulations on a great set of numbers. So just wanted to confirm the numbers that you spoke in the opening commentary. We said that revenues from US this time was around 64%. Is that right for the third quarter?
That's correct.
64-36, right? And manufacturing was around 7. Could you just repeat the manufacturing number for me, please?
Sure.
For the quarter.
So in Q3 FY26, US manufacturing is 22% and India manufacturing is 78%.
Perfect. Thanks for confirming that. Now, secondly, right, in terms of areas of growth, right, while we're obviously seeing a lot of broad-based growth across applications, across each segment, could you potentially highlight what are the particular clients that you're sort of working for, not in terms of names, but rather applications? And going forward, how do we expect that? So we just spoke about how the existing base is obviously going to grow. So if you could just highlight some color on that. And further, the incremental growth which is going to come through, what are those applications that you're kind of looking at?
So that's a tough one to answer when you're chasing broad-based growth. So we would have a time when certain parts of industrial will be split into a different vertical. Let's say when there's meaningful growth in the semiconductor equipment, we will split that out from the industrial vertical. But what we are seeing is growth in a lot of our segments where we are focused, and we're going to go deeper into the segments because some of the customers we have are Fortune 100 type customers where there's enough room to grow apart from the new customers. So whether it's a commodity or a capability, we are going to target that. Did I answer that question for you, Tanay?
Sure. So, and obviously, the Indian operation margins have been extremely strong, right? And I think we're scaling up out there quarter on quarter. But, would you sort of give some update on how we're looking to improve, the US burn, which we're kind of seeing right now quarter on quarter? I mean, obviously, we're ramping up manufacturing out there, but any direction which you would sort of give in terms of the US margin profile?
Sure. So with respect to US manufacturing, which constituted 22% of our business for this quarter, the PAT losses are at around -7 crores. If you look at the last couple of quarters, it was approximately at around -9 crore each quarter. We have been talking about a possible operating leverage opportunity in US manufacturing as well, alongside the India manufacturing. The beginning of that is what we see this quarter. We believe the next year, with the growth in energy storage systems and some of the new businesses that we have won in US can help in that direction. So we are trending towards a direction of a better profitable profile in the US manufacturing as well.
And you also will have to recognize that, in the last 9 months, that was the best thing that we could have had, where having a US manufacturing. So some of the programs are getting started prototyping there, and hopefully in the next 6 months to a year, we may start moving some of it to India manufacturing. So it's just not a factory to factory. It is also the future of export business in India is tied to that factory.
Perfect, sir. Perfect. Thank you so much for answering my questions and wishing you all the very best. Thank you.
Thank you, Tanay.
The next question comes from the line of Archit Shah with B&K Securities. Please go ahead.
Thank you for the opportunity and congratulations, sir, for a very good set of numbers. So first question is regarding tariffs. Now, earlier, because of 50% tariff, we were planning to increase our US manufacturing for some tariff-sensitive clients. So now, what is the outlook on clients, especially on the stickiness and their comfort level after being better off in terms of geography versus our other Asian peers? Do we still stick to increasing US manufacturing, or are we keeping it, keeping it at 20% around?
Thank you, Archit. The ideal goal for us is, 80-20. We've always kind of said that. But today we have a set of customers who have come to US. Some of them want to stay in the US, do not want to take a risk for a couple of years with all these things changing on a daily basis. So they have decided to, next 2 years, they're going to make it there. And the other, half is going to move when things settle down, right? Because some of these programs take 6 months to a year at least to get going. And we have started on these programs, so we will not change the prototyping from our US location. And when the time comes, of course, cost does matter to the customer. He will make the choice when to move. But in the short term, we don't expect any knee-jerk reactions because these are large customers. They have made their policy decision, or I would say, strategic decision to do 1 year in the US and then move. But they have the option to do that. And once things settle down with these tariffs, because tariffs also is very relative, right? It's one thing today, and then things could change in 2 months. Okay, so we just. But the good thing is business is coming from all sides.
Okay.
Did I answer your question?
Yeah, kind of. But just one thing I didn't understand was, since you're recovering 99% of tariffs, how do it impact your gross margin still by 100 bits? When you said that if there were no tariffs, then you could have your gross margin would have been better by 100 bits, right?
Okay. I'll take this, Suresh. So absolute gross margin doesn't get impacted, but the gross margin is a percentage because we incur tariff and then we pass it on to the customer. So both the numerator and denominator gets expanded to that extent. So as a percentage, optically, it could have been 100 bips better.
Okay, got it. So my second question is regarding our manufacturing margins. So firstly, despite our US manufacturing base increasing to 192 crores, our EBITDA margin seems at -7% only yet, which was the same that earlier at 30-40 crores also. So are we still investing over there, and what kind of scale do we need to achieve to start seeing the declining trend? And secondly, on India margin, 16.7% are very strong. So are those sustainable numbers, or is it just quarterly dips, and on annual basis we should expect around 13.5 or 14% sustainable margin?
Sure, Archit. So first things first, most of our business, if not all of our business, are recurring type of nature, long-term businesses. So there is nothing one time or one quarter from a business perspective. These are all long-standing customers for us. That is our key strength. With that said, our India manufacturing revenues, which constitute 78% of our business, delivered 16.7% EBITDA and 12.2% PAT. So this significant number is something that we have been talking in the previous quarters as well, where operating leverage can come and help once the revenue scales. That is what probably we are seeing in the India manufacturing side. With respect to the US manufacturing, the energy storage system business as well as some of the other new businesses started kicking in, and we have been discussing about this in our calls over the last 4-5 calls as well. So overall, the PAT has reduced from -9 crores in Q1, Q2, the last 2 quarters, to approximately -7 crores now. But like you rightly said, the EBITDA is slightly higher than the previous two. EBITDA losses are slightly higher than the previous 2 quarters, primarily because of product mix. If you look at from a full year basis, let's say give it another quarter or two, from a full year basis, I think it should get better as well. So in a summary, I think US manufacturing also within later part of next fiscal year can get much better than where it is today.
Okay, sure. That's it from my side. Thank you so much, sir.
Thank you.
Thank you, Archit.
The next question comes from the line of Vipraw Srivastava with Phillip Capital. Please go ahead.
Hi, sir. Good afternoon. Just quickly, sir, on the order book side, we have seen 25% growth on the order book side, whereas revenue has grown by more than that. So any reason why this slowdown, or we are expecting a pickup in quarter 4?
Thank you for the question, Vipro. For me, we believe the order book has done really well in the last quarter. So it's grown 26%. Look at on a year basis. The business is going faster. But the key is, we're not tying all the orders. We're giving a 14-month number, okay, which is at 2,000 crores. And we are giving you a number which is, for 14 months to 36 months, which is 1,083 crores or so, 1,183. So totally we have 3,199 if you look at that for a 3-year period, okay. We've got orders from 3 years to 15 years after that. We are not counting all that in the order book.
Just to add to that, KV. So Vipro, if you look at our FY25 revenues, it was approximately 1,100 crores. Today we have an order book of 2,016 crores, just to put that in perspective. Secondly, for many of the new programs, we'll be probably having prototype orders right now getting reflected in the order book. So once it ramps up, the volume POs can come and get added in the later quarters.
Sure, sir, that makes sense. And lastly, sir, on the ISM, since you mentioned ISM in your introduction, so just quickly, is the company planning to go for any of these incentives in terms of goods capital in terms of manufacturing equipment, or you are just optimistic that as semicons come to India, you will benefit out of, you will be benefiting as a manufacturer, or you directly want to enter this ISM scheme?
So to answer your question, see, there's been the OSAT piece, then there's the FAB piece. Now we don't know the full details yet, but the ISM 2.0 talks about semiconductor equipment. This is exactly where we are forayed into, okay? And we believe let the details come out, and we believe there'll be something for us to finally use some PLI scheme, ISM scheme to get going. This is one of the industries of focus for us.
Right.
And also remember, we have just got into one customer. There's a few hundred customers out there. Okay, so to put that into.
Sure. Thanks a lot, sir. Thank you.
Thank you. The next question comes from the line of Santosh Seshadri with Avendus Spark. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just wanted to ask first question on this ISM 2.0. So what is the sort of revenue opportunity and TAM size that you're talking about with respect to your capital equipment manufacturing? That's my question number one. And is there any import substitution angle that you're seeing here, or is it mostly an export market?
So you talk. I missed the first part. You're talking of semiconductor equipment, or yeah?
Yeah.
Yeah. So this is primarily for the export market. So it will come back to India, just not for the Indian ecosystem. So that's why we are very much excited that once the approval, most of it is done, and with production starting, this is the first set of equipment we are making. I mean, it's parts of larger machines. we anticipate to see more parts come through as we go forward. So it's not only for India, it's primarily for the global market.
Thank you. And then the second part of the question is that any way to size this market opportunity in India and globally?
No, we don't want to go there since it's, we have our own calculation of where we need to be. But let us get the approvals and the production going, and then we'll probably comment on that when we move this into a separate vertical in the near future.
Thank you. And my just one last question on this, and on the India-US trade deal. So can you quantify the impact of this proposed tariff reductions? If you could give some color on the duty advantage that you have versus Mexico or other Southeast Asian countries, that would be great.
So we've been in the US for the last 25 to 30 years, so we understand the market well. In the last 7-8 months, there have been a lot of customers, on the fence because I can't say I can make it in India faster, better, cheaper, but you pay 50%. Okay, so a lot of people have just put a hold to it. But today, with the 18% number, you're better than a lot of the Southeastern economies, better than China. So I think overall, India stands to gain across the board. I'm just not talking about Avalon now, but across the board. And with the combination of having the US front-ending and India back-ending over the future, that is, I think, the dual model we have. It's where customers are confident as well as they know it's just not set in stone on the status, right? Somebody changes their mind every few months, like what happened with South Korea recently. So, it is being in the two locations helps us quite a bit because customers, not as concerned as just taking it out and having one country specific.
Thank you. Yeah, that does. Thank you. Maybe if I may just ask one more question on the impact of commodity price increase in your business. I understand that it's a pass-through for most of the EMS companies, but can you discuss if there is any lag in that pass-through, and how should we think about the impact of commodity price increase on gross margins?
Yeah, hi Santosh, Sriram here. Yeah, recently we have seen some commodity price fluctuations. We've, like how we do with the tariffs, we're very active in terms of working with our customers to recoup possible. Obviously, a lot of this, there are puts and takes here based on, different customers, different materials and scenarios. So we're actively working through that and we ensure to the best of our ability, these things are covered.
And you're trying to collect in the same quarter.
Yeah, and within the same quarter usually.
Just to add to that, we were able to maintain our gross margins within the guided range of 33 to 35, sometimes slightly more, over the last 5-6 years. So that is something that we've been doing in the past.
So that should continue, right?
That should, in always should. Yeah.
Yes, thank you very much.
Thank you, Santosh.
The next question comes from the line of Karan Sanwal with Niveshaay. Please go ahead.
Thank you for the opportunity. So I have a couple of questions regarding our semiconductor business. So if you could, broadly highlight how big is the opportunity that we are anticipating in the semiconductor space and what exactly Hello?
Can you just repeat the question? We just lost you for some time. Can you repeat the question, Karan?
Yeah, so we wanted to understand how big is the opportunity in the semiconductor space and what products exactly are we targeting in that space from the customers that we have already onboarded?
So what we're doing is part of their larger system. We're not making the whole equipment. These usually are $20-30 million machines, and we are doing small parts of that. Okay. So again, we don't want to give a number the opportunity. These companies earn hundreds of billions. So we are getting our small steps in there with the hope that it's going to be a big part of what we do.
Understood. And sir, apart from the customer that we have already onboarded, are there any advanced talk with other customers in the particular semiconductor space? And from the customers that we have already onboarded, do we have any confirmed order book, or is it in in a prototype stage only?
So the first customer is one of the top customers in the world. But we have prototyping, we have orders, proto orders, and things going on. And then there's the production ramp, which is what we're waiting for the orders to come in and all that. Saying that, we also have a second large customer in talks, but it's early conversations. So we hope to have, as we have to prove ourselves with one, and then I think there's a lot which will follow. Because this is a very difficult market in the sense of complexity, in the sense of what we need to achieve. Because of our box build experience is where I think we are succeeding. So I believe it's tip of the iceberg.
Understood. Thank you so much, and all the very best.
Thank you, Karan.
Thank you. Ladies and gentlemen, if you wish to ask a question to the management, you may press star and 1. Participants who wish to ask a question may press star and 1. The next question comes from the line of Jeetu Punjabi with Investecco Capital. Please go ahead.
Yeah, great numbers. Thank you. I have two broad questions. One, in the context of the current environment, and also you kind of talked a little bit about all the excitement that's happening in the semi chain and all the other moving parts. My question is, as a management team, what are the 2 or 3 pieces on a 12-18 month that is most visible and exciting to execute on, both in India and the US? And the second, I'll ask the second question after we go through this one. But what I'm just trying to get is some color on what seems visible, tractionable, and growable quite well over the next 12-18 months, and what's exciting within that.
So of course, like you mentioned, we've got the semiconductor vertical. We also, in the industrial side, have a certain set of, how would I put this? In the transmission business, as the world goes through a power super cycle, whether it's in India, US, wherever in the world, with the data centers coming in, we are hoping to play a role in which we believe that we have started in India with one of the global majors and started in the US with the other global major. So I think that kind of excites us because this is a 10, 20-year business. When we look for businesses, we don't look for today's orders. Is this sustainable over 5, 10 years, right? So some of the aero businesses are 15-year contracts. So we can invest and reap the benefits of for the next 10 to 15 years to come, right? So that's the aero business is growing, okay, which is another exciting, the number of planes which are coming out. We have number of parts in the 2 majors through tier 1s, and I think that number will grow because the aero, if you look at it, has grown 60% year over year in this quarter. So these are the type of business we look at. Is it sustainable over a long period of time? That's why we're not in the consumer business. That's why we are in certain businesses which come and go, which are price sensitive. We don't get into that in the long term.
Okay, thank you. And I'm fully supportive of not being in the consumer business and staying focused on the B2B side. The second question is, if we kind of hear the whole commentary so far and what you all are talking about, would it be fair to assume that the growth rates in FY27 sustain at the same levels they've done in 26? Would it be fair to kind of think of 25-30% top line growth and sustainable margins over the next 12-18 months?
I believe that, we will do that number you mentioned and more. We are conservative in our approach, but we don't just want to come out and tell the numbers. So, for example, this year we were upward revised because we didn't know where the world is going 3 times. Okay, so and we will continue to do that, but we are very confident of the future. And you need to look at us from a 3-year period. Of course, there'll be one small quarter here or there where we have an issue. But in the longer term, we are very confident because the business that we assigned, like the last question I answered, is for the next 5 or 10 years, right? So once it comes in, it stays there.
Absolutely.
Just to add to that,
sorry, go ahead, Suresh.
Sorry, Suresh. Just to add to that, the last 6 quarters, our average growth has been around approximately 46%. And some of the new programs, what we are getting in, have a long product life cycle, and we're just in the beginning of the cusp of it ramping up, which means the amount of opportunity is also exciting for us. It is just that we are in the process of completing our budget so that we'll be able to give a better picture for FY2027 once we complete that. But just like the past, I think the next 3-5 years is looking promising for us as a company.
No, absolutely. And I have one. So look, I was just trying to get color on high level growth trajectory, and I think that's a very fair comment you've given. But my last question is, assuming this tariff deal doesn't happen in the same format, it's been kind of headlined at 18%, But if it doesn't happen, does that in any way change your trajectory, or is your trajectory teneted on this the tariffs playing out as articulated?
See, that the future, I think lies in the governments. We can't comment on it. When it changes, it changes. We're hoping it goes downwards and not upwards. But if you take the past, how we dealt with the last 9 months or 10 months when this tariff thing started, we have not broken our stride. Okay, we have continued growth. It was confusing tell when we are going to grow, but we've been persistent and with some amount of luck also that we have continuously grown. So I think that will continue, and if the curveball is thrown on us, I think we will survive. It's not nothing is stopped because of the long-term nature of our customers and products and it takes months or even a year and a half to change. So even the customers decided, let's stick and see what's going to happen, right? So it's happened in a positive way now, but through the whole process, they've been very supportive to what we're doing.
To add to that, the opportunities what we have are domestic, which is India for India. And over the last year or two, we have also grown the opportunities on India for Southeast Asia exports. Plus, within the last nine months, the US for US is also accelerating in a nice way. With these 3 growing, how would the tariff reduction, the 4th growth lever on India manufacturing for US customers has added to that? So our growth opportunities are well diversified, not dependent on one geography or one industry or one set of opportunities. It is well diversified in its true sense.
Okay. And if I can sneak in one more quick question, which is this whole BESS opportunity, which we're seeing in a very significant way coming out in power solutions that people are offering end customers. Will this over the next 2-3 years be a significant part of your entire offering? The battery.
I believe, and what we are, So this we do because it's country for country, right? So in the US, they want to make in the US, and this we have worked on for 4 years or more. Okay, finally, the fruits of the labor has come through, and it is going to be a significant play for us into the future. Okay, and we've already ramped up and ramping up further, and we are really excited on that. And the company is well positioned to execute it. Not only as our customer is, it's a well sought out product now. It's the highest end of BSS.
Well, fantastic. Keep up the good work, and we're fully supportive. Thank you so much once again.
Thank you, Jeetu.
Thank you. The next question comes from the line of Avinash Nahata with Parami Financial Services. Please go ahead.
Am I audible?
Yes, Avinash, you are.
Thanks for the opportunity. Two quick questions. One is, what is the 9-month number for the cash flow from operations, if I would have missed out?
40 crores is the 9 months of FY26 cash flow from operations. Q3 is 51 crores.
9 months you said is 40 crores and
9 months is 41, Q3 is 51.
Okay, got it. And with scale, what is the improvement in net working capital possible over the next 1 or 2 years? We have done so far a very good job coming from 160 or 218. So what is the, fair assessment from your point of view over the next 1-2 years?
In the past, we have operated even better than this, but with the current growth rate, I think what we had earlier guided was a 120 to 130 day by March 26. We've already surpassed it by reaching 118 days by December 25. We hope to improve and maintain and improve on this trajectory over the next 2-3 years. Let's say by another, let's wait for our budget to complete. So we'll be able to share a little better picture on FY27, but we are in the path of improving our net working capital.
Yeah, just to add to that, Sriram here. So we've had a quarter-over-quarter improvement in net working capital across inventory, receivables, and payables. This is a structural improvement that we've been working on for a while, and you're seeing the fruits, or the benefits of that now. We're hoping that this continues over the next few quarters, and we will keep updating you, as to how we are progressing on this. We expect to continue this trajectory going forward as well.
Yeah, thanks a lot. That's all from my side, and all the very best to the team.
Thank you, Avinash.
Thank you. Ladies and gentlemen, we'll take this as the last question. It's from the line of Archit Shah with B&K Securities. Please go ahead.
Thank you, sir, for the follow-up question opportunity. So just one question. In our clean energy business, one of the large portfolio is the energy storage system in the US. So we manufacture one of the customers who does this for residential customers over there. So is it a revenue for our customer dependent on government subsidy in US for the solar products or energy storage products, battery management products? And if so, yes, then what is the visibility on government policies over there, and could be affected by any, let's say, if they take back the subsidy or anything?
Thank you, Archit. You see, the fastest growing segment in clean energy in the US is battery systems for storage. It's been growing in the last couple of years, and it's not impacted by the pulling of subsidy in the sense which happened in the wind and some of the other solar stuff. This is a focus for US because of the grid, okay, and with all the data centers coming in, so there's getting closer to home, and I think this is supposed to, but the only issue is that you have to make it in the US, okay, and we are well positioned for that, and that's what we're doing. Though some subparts go from India.
Okay, so one of the requisites is that you have to make in US for those parts, and you cannot transfer it to India for manufacturing?
Part of it. So we do subsystems here and then final there.
Thank you so much. That's it from my side.
You're welcome, Archit.
Thank you. Ladies and gentlemen, that was the last question for today. With that, we conclude today's conference call. On behalf of JM Financial, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.